I wanted to just jump on today and make a really quick video about timing the market. This whole idea of trying to time the market is really not an advertised and encouraged investment strategy. It's this whole idea that an investor is able to sort of predict where a stock or the market in general is going to go in the future. So they are trying to basically predict when the lowest of the lows are going to happen and buy at that price point, and then sell when the high has been reached in order to make the biggest profit. Of course, I've just said the word predict, predictions. That is so hard to do, and most people absolutely fail in doing so, hence why it's not really an encouraged strategy. But there is also no denying that if an investor was actually able to do that, they were buying right at the dip and selling at the top, they're going to make a much better profit. However, I want to talk about how that fits into long-term investing mindsets. And also, I've got a few examples using real numbers, real stocks to go through, just to show you how much not timing the market versus actually being able to time the market impacts your future return on an investment. So without further ado, I'm going to share my screen. We're going to look at some real examples and actually figure out whether it's worth all the stress. So basically what I've done here is I'm going to look at Tesla stock and Apple stock, two very, very popular companies to invest in these days. And we're going to look at short-term Tesla and long-term Tesla, and then just Apple in general. I'm going to explain what I mean as I go through. So what we're going to imagine is that an investor is trying to basically buy Tesla shares at a lower price. They really care about trying to time this dip, if you will. And we're going to look at what that means if that is to happen, if they are able to buy at the dip versus if they're not able to buy at the dip, and how much that impacts the future return. And we're going to look at that over a short period of time and then a long period of time, because there's no doubt that being able to time the market is really, really beneficial in terms of short-term trading. If you are trading in and out of stocks, then of course you want to buy low, sell high, move on. Do it again and again and again and make profit that way. But it doesn't come into play as much when you are looking at holding a stock for a long period of time. But we're going to actually take a look at the numbers. So let's have a look at Tesla in the short term. So what I'm going to do is I'm going to pick a price point when Tesla was at a bit of a high during that period of time, and this is short term. So I'm not looking at this whole graph here and picking the highs and the lows. I'm going to look at a little zoomed in section, buying at the high of that time period, the low of that time period, and what that means. So you'll see I've already looked at the numbers and popped some on the screen. So let's just zoom in and take a look at this. So I've picked a high point looking at a short time period of November the 27th, 2020. So let's just zoom in to this Tesla stock chart here. And then we need to find November 2020. There it is. So on the 27th of November 2020, Tesla stock was $195.25. Have to remember to convert it and not say pounds and pennies. $195.25. So if this investor was basically not really trying to time the market, or they tried and they failed and they bought at this price point, they would have paid $195.25 per share. But what if this investor was actually able to know that this stock was going up and they bought at a lower price? So the lower price point is on the 30th of October 2020 here, $129.35. Okay, so clearly buying on the 30th of October versus the 27th of November is a cheaper price point. You can see here that the stock went up. This was much higher than this, but if you zoom out, you can see that there's all these little peaks and troughs happening all the time. So let's actually take a look at what this means. We're going to assume that this investor had $1,000. I put pounds here, but I mean dollars. Tesla is traded in dollars. $1,000 to actually spend. This means that if they were buying at that higher price point that we saw, they would have had 5.12 shares, roughly speaking. Whereas if they were able to time the market or know that it was going to carry on going up, therefore they bought at the dip, they would have got 7 shares 73, 773. Clearly, the more shares you can accumulate, the better, if it's a stock that you really believe in. But what does this actually mean? So over this short period of time, if they bought at the high price versus the low price and then they sold today, what's the profit difference here? Let's actually take a look. Okay, so if you paid the higher price per share, the profit that you would have today on that original $1,000 invested would be about 1,012. Whereas if you purchased at that lower price, it would be about $1,528. So clearly there is a difference, about $500 difference. And of course, $500 is quite a large difference when you're only actually investing $100 to begin with. However, like I said, this is assuming you are able to actually time the market. For a lot of cases, the investor would have seen the stock price start going up. They would be thinking, oh, I don't want to pay that. I don't want to pay that. And then they would have kept going and going and going. And the next opportunity may have been over here for them, which is quite a long time without being in the market. What if this just kept going up for a while? Then what? Do you just not invest because it keeps going up? It's really hard to actually know what to do. And I think as well, when you're trying to time the market for short-term trades, it kind of makes sense. Like if you were buying here and selling here, great. Buy in here, sell in here, still a short time period, great, you've made yourself a nice profit. But what if you're actually trying to invest for many, many years? So this is where the next example comes in, Tesla over the long term. So again, we're going to look at two different scenarios, a high and a low. This time we're going to assume the investor bought back in 2014 and they sold again today. Today is actually a Saturday, so you wouldn't be able to sell. It would have to go through on Monday, but we're just using examples here. So let's once again zoom in. So the high price is going to be the 7th of March 2014, which is really not very high when you look at the Tesla price now, but hindsight is a great thing. So let's find the 7th of March 2014. There it is, 16.41 per share. So if you were buying at this price, you would pay $16.41 per share. But what if you somehow knew that this stock was going to go up over a short period of time, and instead you decided to purchase use your $1,000 on the 17th of January 2014? You'd pay $11.33 instead of that $16.41. So let's see how many shares you would have got for the $1,000. If you bought in March, you would have got $16.94. If you bought in January at the slightly lower price, you would have got more shares, obviously, $88.26. And then imagine this investor had invested the $1,000 and then they left this investment to do its thing over a long, long time period. And actually they waited till today's date in 2023 to sell this stock. If they paid that slightly higher price, they would have $12,053. And if they purchased it at the lower price, $17,456. Clearly, these examples show that if you pay a lower price for a stock, you're going to get more profit in the long term, or even the short term. Like there's no denying that. If you pay a lower price and the stock goes up, great. You're going to get more money than if you paid a higher price and the stock goes up. That's a given. But trying to actually do this is a whole nother ball game. It's really, really quite difficult because how on earth are you meant to know? And it sort of comes with this psychology that is probably not very healthy for someone that is trying to do long-term investing. So let's take a look at Apple now. And let's assume an investor decides that they want Apple in their investment portfolio, and for whatever reason, they were able to time a little bit of a dip and they paid the price of $14.33 on the 23rd of September 2011. So around this sort of time. But let's say another investor, or in a different scenario, the same investor wasn't able to get that dip and actually bought at a bit of a higher price and they paid $15.07 per share instead. What does this actually mean? Well, $1,000 would actually get the person paying the higher price $66.33 worth of shares, and the lower price would get just under 70 shares of Apple. We can clearly see that since 2011, Apple has had an absolutely phenomenal run. Look at that. So let's see if they sold today, how much these two would have made. The person paying the slightly higher price would have $10,022. The lower price, $10,538. And again, this is about a $500 difference. But over the period of time that this works out to be, 2011 all the way to 2023, $500 really isn't that much of a big deal. And of course, this is quite oversimplified. Obviously, most people wouldn't just invest $1,000 and then not put any more money into it. If it's a stock or a position that you like, you're probably going to end up buying at different price points, and then they will just average themselves out. I wanted to just look at this as well, as it's a little study that helps really summarize this idea of whether market timing is actually worth it. So these are 5 different hypothetical situations. You have one person that is able to time the market perfectly. Realistically, that is not going to happen, because not only do you have to time your buy price perfectly, you have to buy the dip, you also have to be able to time when it's at its peak. So you have to be able to time the market perfectly twice. That is hard. Doing it once is hard, let alone twice. So this situation is hypothetical, probably not going to happen in the real world. The next one along is just someone that likes the idea of having a stock in their portfolio and just buys it immediately. They don't really care if it's up, if it's down, they just buy it. The next one is dollar cost averaging. So this invest immediately would be like a lump sum investment. They've got £1,000, they just put it in, buy it, move on. Dollar cost averaging would be someone that purchases at lots of different prices, so they get the ups, they get the downs, and overall it was just sort of average out the price. Bad timing. This is probably a lot of the people that try to time the market, right? So this is bad timing. Those who try and time the bottom or the top and just get it wrong. You can see how volatile some of these graphs are. Let me just flick back to Tesla here. Look, up, down, up, down, up, down, up, down. If you try and time this bottom, you're probably not going to be able to, and then you'll end up just buying it when it goes back up. So the person that has bad timing is probably trying to time it and just not doing very well, or they just really suck at trying to time the market. And then this last one is someone that stays in cash. So this is someone that just doesn't invest at all. Now, I think the biggest take home here is that investing versus not investing is a massive difference. The person that stays in cash is actually the worst off out of everyone. So if you're going to try and time the market, or you're going to dollar cost average, you're going to lump sum invest, whatever, you're going to have bad timing. All of them situations are way better than just not bothering at all. That's the primary point here. But also what we can see is there's not that much difference over someone that dollar cost average or lump sum invests. Lots of studies out there show that lump sum investment gives you a better return than dollar cost averaging. But do you know what? I don't think it really matters. The difference between these two things are so minimal. And a lot of the time, people will actually do a mixture of both over the total time that they're investing over their lifetime. And also another thing here is that there's not much difference between someone that times really badly versus someone that times perfectly. I think the last thing to point out here is that if you are trying to time the market perfectly, you're probably not going to be able to. You know, the odds are against you just because you can't really predict the future. So you're probably going to end up trying to be in this category, but actually being in this category of bad timing. So why not just not risk that at all and accept that you're going to do this, one of these two, and have a really decent return. Now, there are a few more things that I want to say. I think that if you've got really strong conviction in a stock, so let's say you really believe that Apple or Tesla is going to be worth way more in 10 years than they are today. Like maybe you think Tesla's share price in 5 years is going to be $500, $800, whatever it may be. You really believe that it's going to go up from where it is today. Then I wouldn't really have too much panic about trying to buy the dip versus not, because buying today at $197 versus in 3 weeks when it might be 207, it's not going to make much difference to the overall return if Tesla gets to where you think it will. My personal opinion is just that if something seems really overvalued right now and you don't want to pay the price for it that it's currently at, then just wait. It's probably not a good opportunity for you, and just see if it comes down. And if it does start coming down, maybe you then establish that the new price point that you've seen it at is a good opportunity and you buy it in at that price, rather than trying to actually manipulate the exact moment when it hits the bottom. Just look at it and decide, is this a company that is worth this price right now? No? Okay, I'll wait, I'll keep it on my watch list. Or yes, great, I'll buy it. But on the flip side of that, I think if you have a stock that you really like and you want more of it in your portfolio, and for whatever reason the stock price is down right now, and you believe that the intrinsic value of that company is way higher than what's being reflected by the stock price, then just see it as an opportunity and buy more whilst you can, whilst it's on sale. I do think there is a big difference between trying to time the market and just seeing opportunity and taking advantage of it. It's the difference between trying to actually know when the dip's going to happen and just sort of seeing that something is at a lower price than you've seen it at recently, so you're going to buy more. When you say it out loud, it kind of sounds like the same thing, but I really believe that there is a difference there. And the last point I want to add before I wrap this up is that if you really like a stock and you really want it in your portfolio, but it hasn't dropped by that 10% you were hoping to see, then just buy it anyway. Because at the end of the day, it could be really detrimental to just keep waiting and waiting and waiting for it to fall, and it may never actually get to the price you want to buy it at, and then you've kind of missed an opportunity, because obviously time in the market is more important than time in the market. And actually, the investor that stays invested for long periods of time normally gets the better outcome than the person that is waiting for an opportunity that may never present itself, and then they've lost out on months, even years of not actually being invested. So those are some thoughts. Let me know your thoughts as well. And if you want to check out my Patreon and join the Discord, then I will leave a link in the description. Thank you so much for watching. I hope you enjoyed this video, and I'll see you very soon with another one.